Greetings. I'm Scott Robinson, clinical professor and director of the REIT Center at NYU Schack. It is my great honor to welcome you to our inaugural REIT Symposium Research Day conversation about ESG. ESG is not a new concept, but it is new enough among REIT investors to warrant further discussion and analysis. Like many aspects of our socioeconomic environment, the pandemic has accelerated emerging trends such as digital infrastructure, awareness of the impact from climate change, and the need for a more inclusive and diverse employment landscape. I hope today's discussion will be the start of an ongoing, productive conversation about ESG across the REIT ecosystem. Helping me make sense of these topics today is Professor Stuart Brodsky, director of our Center for the Sustainable Built Environment. Stuart?
Good afternoon, good morning. Thank you everyone for joining us today. Yes, the issue of ESG has been a growing one in real estate. I've been in this space for many years now with a focus on the E, the environmental, but the same stakeholders who have a lot of questions about the environmental performance of real estate assets and real estate organizations have recognized that similar questions can apply to issues of social performance, meeting social obligations, and also metrics and measurement of the governance practices of organizations. From an environmental perspective, or from a total ESG perspective, we know that 1 in 4 professionally managed assets, $1 in $4 professionally managed, is now being managed with a screen or an obligation or a commitment to look at ESG issues. The real estate investment trusts have been tapped for many years now as a model of reporting, at least because of the public nature of their books, and have been asked to report and demonstrate ESG performance to their investors, where their investors, and particularly institutional investors, are large sovereign wealth funds and public employee retirement systems from all over the world that are operating in countries that have a mandate to address environmental issues, and again, now also social and governance issues. So that's the universe, that's the landscape in which we have this conversation and are joined today by David Harris and Kimberly Chen.
Thank you. Just by way of background, I mean, I have over 30 years involvement in public real estate. From 95, when I moved to work in the United States, live in the United States, I've been involved in the REIT market. So pretty much from the start of the modern REIT era. I've had buy side and sell side roles, all on the equity side, I hasten to add. I'm presently a portfolio manager for a company called Uniplan, which is an alternative asset manager. We run funds in REITs, in high yield and small cap, and I do get involved in the other areas as well. So I kind of bring a broader market perspective, not purely focused entirely on the REITs. So let me hand it over to Kimberly. I think probably can also give by way of an introduction, I'm thinking.
Yeah, so I provide the counterpoint, I guess I could call it, to David, in that I've been nearly 20 years in commercial real estate credit. I started as a lender at M&T Bank here in New York City. Then I moved to Fitch, where I rated CMBS during the Great Financial Crisis, or pre-financial crisis. And then when the Great Financial Crisis occurred, I moved to the REIT group. And in 2012, I moved to AllianceBernstein as a REIT and CMBS credit analyst. And today I'm a portfolio manager of long-only REIT preferred and bond funds. And I'm also responsible for our REIT public and private bond strategy. So I've really been exposed to many of the different aspects in terms of the real estate credit business. I'm actually also an alum of NYU Schack. I attended part-time while working at M&T and Fitch.
Okay, great. Well, thank you very much for committing your time today. There were a number of topics that we had explored, asking you to launch into. I'm wondering if Scott wants to kick off by reviewing one of those topics.
Yeah, it's great. Thank you. I know COVID has really kind of pulled forward a lot of emerging trends that we had been talking about, whether they were digital, whether they were social, whether they're climate. I think the E has been a major focus, but increasingly the S and the G. Why don't we set the stage a little bit on where each of you, from your credit and equity points of view, sees the REIT market going forward as we come out of this COVID containment period, and which of those, if any, maybe all three, will be equally focused upon by both investors, whether they're credit or equity investors like you, or the REIT managers. Kimberly, you want to pick that one up?
Yeah, sure. So, I mean, 2020 was a record year in terms of EBITDA dropping for REITs. And I actually think that 2021 will continue to be a year that challenges the EBITDA growth of many of the REITs. And if we take a few steps back in terms of investment grade REITs overall, their balance sheet leverage was pretty good going into COVID. There was certainly some cushion that they had. And when we think about kind of the negative rating outlooks and changes that occurred in 2020, we saw 75 negative outlook changes or rating downgrades. And what's interesting is that REITs actually showed their ability to sell assets fairly well during COVID, despite the fact that real estate was literally closed, and they were able to keep their debt levels in check. So as a credit analyst, I really looked very closely to see what is the liquidity of the asset base, how well do management teams manage that leverage profile. And so overall, I would say a year after the onset of COVID, in terms of the balance sheet, REIT management teams have done fairly well, and we would expect to see a reversal of many of those negative outlooks and potentially even some upgrades. I think when we look at the E, S, and G factors today, I think that the E factor is something that has been around for a while, but it's hard to quantify. It's, and S is going to continue to be a factor, but for us, governance has been kind of the biggest factor that we've looked at over the last few years, actually since the modern REIT era, essentially. So, David, do you want to give your thoughts on the outlook?
I think the REITs have actually performed pretty well over the last couple of years. Obviously, it's been a shock, the like of which none of us have experienced in our working careers. You've got to go back 100 years for society to have dealt with something like this, and none of us are quite that old, even myself. So as we look at the REIT sector today, it's really bifurcated between the areas that have done well through COVID, and have actually, in some cases, actually been beneficiaries. So I'm thinking of the tech-related towers and data centers. Obviously, industrial distribution space has come out of this. And then on the other side, you've had the areas that have been really pounded, such as retail and lodging. And as we look at the outlook today, you've got a lot of money now riding on the reopening trade, as it's called, which is retail coming back and lodging coming back. In fact, there's been one of the marked features that we've seen over the first quarter has been the rotation trade, if I may go into another trade reference, which has seen money come out of kind of the high-flying tech, NASDAQ stocks, partly because we've obviously got this inflationary backdrop, which Kimberly knows all about, of course, and higher rates, prospect of higher rates. And that's causing money to come into more cyclical rebound areas of the economy, and REITs have actually outperformed, somewhat surprisingly, against a backdrop of higher rates. In terms of the ESG, governance has always been kind of front and center. REITs had the kind of a structure which I think was challenged and raised some questions in investors' minds right from the get-go. I'm thinking of things like operating partnerships and the rules of 100 shareholders and the 5 and fewer and all of that type of thing. So that's been kind of worked over. I think although standards are pretty good, I think we still have got a long way to go to get to actually best global practices on a number of issues. I think if you look at the other areas, obviously climate is now become front and center for most corporates, and we're living in this more stakeholder kind of perspective of what the corporate structure should be, how corporates should be responding, as opposed to the pure kind of Milton Friedman-esque, purely focusing on shareholder returns. And I think culturally, I think companies are still kind of struggling to get their heads around that. So they still have a lot of old school thinking, and I think that is, that may be just a generational thing that actually needs to kind of burn off, as it were. But clearly, buildings are recognized as being big carbon contributors. Property owners are being stressed by their tenants as well as by regulatory changes to up the environmental efficiency of these buildings and reduce waste. And then on the social side, that's become more prominent part of the equation in the last couple of years, I think, in particular this last year, inequality, diversity, etc. we're not really at the front line of that. I don't think in the real estate area, we're not huge employers. We don't have supplies from slave labor in foreign countries. So we're not it is an aspect, but it's much more of a bigger issue for many other companies in other areas. And again, I commend the companies for kind of stepping up and addressing this, as Scott referenced. I mean, you've seen some in the opening, and you've seen companies really embrace this and be given us good disclosure. But like Kimberly said, I struggle as an investor to get my head around what standards we should be looking at. There seems to be no uniformity, no agreement on what standards should apply. That still seems to be work in progress. It's kind of early days. It would be nice to see a bit more leadership, perhaps, from the industry in terms of sort of pointing us in the right direction, but maybe that will kind of coalesce over time. Obviously, we're still recovering from the shock in this industry of COVID, as we are seeing so many areas. So perhaps it's, as things sort of progress and settle down a little bit more, perhaps one can expect perhaps a little bit more kind of leadership, putting time and resources into giving us some direction on ESG matters.
Well, that's interesting, David. Appreciate it. I know you touched on a lot of things that Professor Brodsky and I have spoken a lot about over the years. Not only, should the E, the S, and the G all be smushed together. I know it's difficult to separate them if we're going to really talk about, shareholder capitalism and true impact investing and leadership. But there's also the market-driven consensus. Professor Brodsky and I have gone back and forth on this one a lot, that, should we let the market kind of dictate where this evolves, or should we have more of an influence on it? And I think, Kimberly, AB's taken a pretty strong approach on ESG. You have a very robust platform, not only in real estate, of course, but across industry sectors. You want to speak a little bit about the criteria and overall thinking there?
Yeah, so it's interesting, like David mentioned, it's very difficult to harness the information and figure out, how does it actually all feed in, especially when companies are kind of each reporting somewhat disparate information. So we have a fairly strong process in place, and we have been. I mean, ESG has been integrated, and we continue with engagement. And we really think it's table stakes since I've been at AllianceBernstein. I mean, we signed this UN Principles of Responsible Investment in 2011, and the fixed income group really pushed for us to incorporate our ESG into our internal credit ratings. And that's not just for us as credit people, but it's also our clients. We have a lot of clients across the world, and it's just a given for them that we are incorporating these factors into our investment process. So let me go over what the investment process looks like for a minute here. We start with a base rating, and it usually references the credit profile. We evaluate the corporation based on 6 different pillars or so: industry dynamics, competitive positioning, and ESG is one of these factors. We then notch our internal ratings up or down based on the assessment, including these ESG factors. And then how does it actually get put into play? We, the analysts and portfolio managers, look at these different credit ratings and range of outcomes, and we try to see, well, do these ratings reflect what our views are, and then marry that with what's actually being priced in the market. Our job here is to actually find out, we're in the business of finding mispriced bonds. So we need to look and see, where we have a truly different view on a credit than the market. And so, for example, a poorly rated ESG company, it probably is excluded, and depending on the market price and other scores, it's likely to be excluded from portfolios. But the thing is that, we, as a fiduciary, we don't just say no to anything. There's always a price that we could potentially buy something. It's just whether or not it has the right structure and is appropriately priced relative to the risk that we see. And so, we also do use some third-party research, but it's a little bit more backwards looking, I would say. But for us, we're really trying to push the companies to give us information that can be benchmarked. And actually, when you spoke about kind of separating out E, S, and G, we do separate them out today. They're not equally rated in our framework. So we assign the most weight to governance today, just given all the legacy issues that we've seen, as David also mentioned. That's really been a huge factor in terms of the performance of a company and its credit. That is then followed by environmental, and then the least weight, although it does hold some, is social. And so if we want, we can talk a little bit more about governance, unless David wanted to talk a little bit more about what he's doing on his side.
No, I think your process seems to be much more formalized, as you might expect, working for a much larger organization. So yeah, in our process, we do take account of these things, in particular, obviously, governance, which predates the recent rise in ESG as a sort of concept. And then the environmental issue is certainly becoming more something that we're being asked of by our clients. And obviously, too, you're conscious of it when you're looking in the individual stock options. It's part of the underwriting of the business, because if you're in the retail area, many of the retail tenants are asking their landlords to be compliant with their environmental issues. It's an important part of their business strategy, and they will not want to be signed up on leases on buildings which are not meeting their requirements. So there's pressure on the companies on two levels. But as I say, it isn't really a formal part of the way we assess, underwrite the investments. And to date, I mean, Kimberly, in the debt area, you may have made more data on this. Is although I am certainly sympathetic to looking for companies to raise standards, and I do believe in the long term that these will actually enhance performance in many areas. And obviously, you've got to go through the lines and think how much is going to be important in terms of climate, in terms of diversity, in terms of governance issues. At longer term, best practices, I think, will bear out in performance terms. And we are invested in a long duration asset too, as well. But short term, equity investors are interested in the next quarter. Yeah. So it becomes a sort of time issue that I'm waiting for performance. Your investors are looking for performance today, which really raises an interesting point. And perhaps I'm sort of jumping ahead, but we maybe want to revisit this. Is as a public guy who's long supported the public format as being the best way for investors to invest in real estate, is I wonder how easy it is for the private equity model to fit to this, given that you're contrasting in public equity, it's a permanent equity structure. They can think long term if they choose to, right? Now they are under pressure, obviously, on a quarterly basis or even shorter term or very short term. But private equity, by definition, is out after 7 years or fairly after. It doesn't make much sense for those guys to be spending a lot of time thinking about upgrading their buildings if they're just simply looking to flip it and generate IRRs and pay out the returns to the shareholders. So I think the private equity model, and you don't have anybody in this discussion from private equity, but I'd be interested to hear how they are thinking about this, given the very different time perspectives that are applying in the different investment formats.
Yeah, I mean, well, I guess, certainly I'm not a private equity investor, but from a bondholder standpoint, we do have accounts that we buy 10-year bonds or longer and have them for a buy and hold to the end of maturity. And in that kind of framework, that's something that we take very seriously and think about, well, what's going to be our takeout at the end of that term? Yep. And I do appreciate your point about public REITs having permanent capital structures. And I think the best management teams are going to really think hard about what is their true strategy, and how does ESG actually fit into that strategy. It's interesting when you think about kind of where we've come since the modern REIT era, where you had families that owned real estate and they just happened to own it for 20, 30, 40, 50 years. And the people came to them. It's not like that anymore. You have to be very strategic in what is your portfolio. Where do you want to be? Where do you want to go? And that's, in my view, I think, where both the M&A strategy as well as the ESG strategy really have to go hand in hand, because people aren't going to buy something like a green bond, which we can talk about in a moment, if it doesn't actually fit the strategy of the business.
So let me introduce an even broader concept here as well. If we think about property returns for the last 20, 30 years, they've been jet fueled by the decline in interest rates, which has created asset price appreciation from cap rate compression. Well, we're at zero, right? I mean, forget the very short-term pressures we've got on interest rates, but the only way from zero is up, right? So it's hard to imagine that property returns are going to be jet fueled by cap rate compression as we go forward over the next 5, 10, I don't know, going beyond a couple of quarters is hard for me, but let's just imagine we're there. Next 5 or 10 years, property cap rates are probably not going to be going down. They're going to be going up, which means that your property returns are going to be generated from your operating efficiencies. And there, I think this is where the E in particular comes into play in a way that it has not really been. If you're generating returns and you're putting your money with an investor who's got an eye for flipping properties, that's been a terrific formula for generating returns. Now, it seems very hard to see on a large scale that is going to be the backdrop to where property returns are going to be generated from over the next 5 to 10 years.
So you say that, and I think back to my days of working with a focus on energy efficiency, and I would point out that data has shown that if you randomly selected, let's just say office buildings, 1,000 office buildings from across the country, and looked at their energy consumption, you might see a difference in rate of energy consumption of over 300 or 400%, where that range is not positively correlated to age of the asset, type of client you have in the building, or the climate and weather.
Yeah.
And it is in that range that there's presumably a margin of efficiency that can be had that you're saying, or is the ESG market saying is where you can find an advantage in one firm over another, and therefore identify an upside for investing in one? Is that within the scope of your analysis, or is the reporting metrics so much broader than that you don't dig into that?
It's the latter, I'm afraid. Unambiguously.
It's an interesting concept and something to think about, because if you remember when the Bank of America building was being built on Bryant Park, I think it needed a lot of subsidy in order to make it profitable.
Yes, well, it took advantage of a lot of public subsidies in order to experiment on technologies, some of which have proven out to be valuable and contribute to energy efficiency in the building, and some of which not so much. That's the nature of the public benefit program for the energy efficiency part of buildings.
The other thing to say too is, if you think about the actual sales of buildings, I'm not sure that the evidence is, we don't have enough evidence to tell us that the building that has got all the bells and whistles from an environmental property is the valuation uplift is material compared to a building without them. Obviously in New York, you've got these requirements that are cutting in 24 and 30, which is kind of overlaying. I'm sure that is making a point of differentiation. But to justify putting all of the extra things in to go to the highest standards, I'm not sure it's necessarily being reflected in the investment values of the individual properties, let alone at the company level.
That's precisely the question that I have for you. Is where do these efforts distinguish themselves from materially adding value to the asset and to the investment, or is this a leap of faith?
Well, I think you have to go back to the permanent equity structure, and if you're developing if Boston Property, I shouldn't use the name, if you're a developer and you're building a building that you intend to hold on to, then you can probably better justify spending a lot on the additional capex to achieve the highest environmental standards on materials and processes, etc. But if you're building it as a developer to flip it, then what's your incentive if there isn't really, you're not going to get payback on all the additional costs that you've been put in to get to that higher standard? If the developer who intends to hold it would be prepared to underwrite for that longer period.
Right. Well, I think the market assumes, or the green building sector of the market assumes or asserts that if you have a green certification, then you've got the working vocabulary within that certification to say that my building, which I'm flipping in 3 years, does have superior value. Look, it's green. And I think the market is not convinced by that.
Right. No, as far as I can see, I think that's right.
I've not necessarily seen the underlying building operating expense ratios to see, from time 0 to time 10, how those have improved or not improved. And it's still a bit opaque if tenants are willing to pay more for a LEED Platinum building. And I think that's where the difficulty is. So that's a little bit of a leap of faith. And, I did mention the green bonds earlier. This has been a way for public companies to finance themselves in the public bond market. And it is interesting. This market has actually grown extremely fast over the last few years. And so a green bond is a fixed income instrument where proceeds are earmarked for environmental solutions. They've actually been around since about 2007. And when I look at the US REIT market, about $200 billion of the REIT bonds there's about $200 billion of REIT bonds outstanding. 12 billion are green bonds, and 16 out of the 65 REITs issue a portion of their capital stack in green bonds. And it's quite interesting. Of course, we encourage green bonds, but we are mainstream investors. We want to make sure that the ESG makes sense and that we're doing our fiduciary responsibility. So we're not necessarily going to pay a lot more for a green bond, but really, one thing that's become a big controversy in the fixed income market is greenwashing. So for example, if the bond market as it is today is so hot, companies are trying to issue green bonds that may not be as rigorous, or the reporting and allocation of funds may not be as rigorous as we would like. And so a green bond differs from a regular bond in that the indenture states the actual use of proceeds. And internally, REITs have to show the allocation of the proceeds to a specific eligible green project until the maturity of the bond. So it is interesting when we talk about kind of the long-term nature of investing in these green properties. If you're actually a REIT issuing a green bond, you have to be very careful to what you are utilizing those proceeds, because they have to publish an annual report about the specific allocation of those proceeds, detailing what's going on and actually the metrics that these proceeds are impacting. And so there's certainly a cost to maintain these bonds. It's not, you can't just do an overnight bond deal and it's fungible. There's actually internal tagging as well as external reporting. So it is interesting that today, the green bond market, maybe you get five basis points better pricing, but it's not significant. The problem, though, is that you really, like I mentioned earlier, if a company really wants to issue a green bond, we as investors always double check, does this actually make sense with what they're telling the broader market? Does this fit within their green strategy or their corporate strategy more broadly? They can't just be issuing a green bond because, it helps to, refinance their higher coupon, bonds coming due next year. It really has to be checked, and it's tough when companies are all, trying to get that incremental better refinancing rate. So it's a tough thing to wade through, but I do think that the bond market continues to refine the pricing and what's required of these green bonds.
So, Kimberly, what percentage of the bond issuance from the REITs is in the green form these days? You quoted the number, but what percentage does it represent?
So that's like 5%.
And would you 5%, say
it's very small so
very
far?
Small.
Would you say that's small relative to how long it's been in place? Do you think it's on the right trajectory, or do you think it's staying small and that's just an indication of something we need to look at?
I think that REITs are being very careful as to what they are using the green bonds for, right? Because they really don't want to be stuck with a bad asset with a green bond, because you're better off calling the bond than holding on to a bad asset. But if we look, so it's 16 companies that have issued green bonds. And when I look at the property types, it's interesting. You have mostly office buildings, some shopping centers, you have some healthcare REITs, and you actually even have a hotel company. So it is interesting when you look at the diversity of property types that are able to issue.
Yes.
And, I think I think management teams are being careful to make sure that they truly are utilizing the green bond for an appropriate purpose.
Well, it strikes me that we need to be careful what we mean by green. If you look at a green building certification program, it actually looks at a wide range of environmental issues. And I'm not saying that they're not all valid, but it's conceivable that in the era of a focus on first COVID and then on climate issues, that we dig down and disaggregate the word environmental or green into its component parts and recognize that there are elements of green bonds that maybe should be focused on the energy efficiency and the carbon performance of buildings. But where does that leave the rest of your conversation? And what sort of standard metrics can you tap into in order to focus on that?
Exactly. I mean, in my so like I mentioned earlier, we as fiduciaries, as mutual fund managers, as fund managers, generally we're in the business of finding mispriced bonds or relative value. So for me, for example, understanding the total number of LEED certified buildings isn't as helpful as understanding the percent of the portfolio that, for example, is platinum LEED. And the thing is, for me, I always thought that REITs should be larger issuers of green bonds because we already have the LEED and GRESB framework. That E portion shouldn't be so difficult. It's just that there has not been any real harnessing of comparable information or real push for REITs to publish comparable information.
Do you see the fact that that LEED and GRESB were kind of developed by the market or by a portion of the market for the market? Is that likely to lead to the development of a reliable standard, or do we need to have the SEC come in here and say that they should be the authors of a standard?
I'm not commenting on the SEC.
Well, I mention it because certainly under the Biden administration, we're seeing not just environmental but social equity issues being integrated into the conversations about regulation and reporting across all industry sectors.
Yes, yeah, and it's actually interesting. I think that. So for REITs, like green bonds make sense, but for some of the multinationals, different countries, they actually are issuing social bonds, which is really interesting. So for example, I think, some certain emerging market countries or related country parties are issuing bonds for like women empowerment, which I believe then the proceeds are used to invest in women-led owned businesses.
I see.
But like David mentioned, REITs aren't particularly a large employer. I would say that, for example, a healthcare REIT that is the landlord to, healthcare properties, particularly seniors housing or skilled nursing, that does kind of fit a little bit more into the social fabric of improving the social fabric of the United States for our aging population. So, we have responsible investment funds. And so while they may not be green bonds specifically, right, we do think that they fit within the framework of doing good by ESG.
Mm-hmm.
Let's go back a little bit. I think in our pre-conversation, we were talking about where ESG should reside: real estate focused, corporate finance focused. Let's dig in some of the other stuff a little bit. Kimberly, you said you really focus a lot on governance. David, did you as well? I know that's always historically been a little bit of a squidgy topic in some respects. It's not as easy to point to those aspects as it is to say, a green building and the impact that might have, even though that's also a little squidgy at times. Let's go back a little bit and talk about governance. How are you guys thinking about governance aspects?
Governance has been a big topic for a long time for us. And, we look at board structure and decision making. And look, we as bond investors, we don't have proxy votes, but it's super important for us to be thinking about what is a company doing, but with the management team, the board of directors, that may impact their cost of capital. Because REITs have to pay out 90% of taxable income, so we better make sure that they have access to capital. And so we look at board structure, make sure that they're not entrenched, make sure there's a diversity of views. We look and see whether or not the companies are externally managed. we find that externally managed companies have potentially a higher instance of misalignment. And while they're not uninvestable companies for us, we do think that they incorporate, we need a higher risk of return to invest in a company with those potential inherent conflicts of interest. You know, a lot of REITs in the yesteryears had a significant amount of family ownership and voting rights that were more heavily favorable to the families. So that's something that we also looked at. And then from a bond investor standpoint specifically, we have to protect ourselves against a go private event. So while for an equity holder, go private may be terrific because you're getting great uptick to your valuation, REIT bond investors actually could remain outstanding. So this is a problem. And so this was something that was contemplated at the very beginning of the REIT bond market when insurance companies were some of the first investors in the REIT bonds. Historically, insurance companies were also very large investors on the mortgage side for these companies. And so as the REIT industry grew and wanted to access the unsecured bond market, you could issue a bond overnight as compared to take 3 months or so to issue a mortgage. So these insurance companies said, look, we'll go and be a bondholder of yours, but you need to make sure that we have similar credit standards to what we're doing on the mortgage side. So for example, we have covenants now on REIT bonds, which require a limit on corporate loan to value. There's a certain amount of unencumbered assets that are required. There's a certain amount of mortgage assets that can be, you know, very extremely limited, and then a certain number of minimum debt service coverage. And so the market requires this of all investment grade bond issuers. So, you know, we need to make sure that even if the company is taken private, that there is reporting on at least these levels of covenants. And you know, if a company were to get to the maximum level of these covenants, it would imply somewhat like a BB type of rating. So, you know, we're protecting ourselves somewhat, but for the most part, many of the REIT management teams today on the public side are operating with significant cushion to these covenants.
So from the equity side, yes, I mean, historically, we spent a lot of time looking at management track records and then obviously within the governance structure, which has received more attention in the last several years. I mean, I would echo many of the points that Kimberly talked of, although obviously she has specifically highlighted some areas that are specific to the debt side. I mean, holistically, and looking at sort of best practices elsewhere. I mean, I just throw out a few areas where I think we've still got some headroom to improve. I mean, I personally came from an environment where the chair and the CEO roles were separated. I think that, you know, it's not perfect, but it's better than it being combined, quite frankly. And although we do mitigate that with the lead independent status, it doesn't have the same status as an independent chair, I don't think, in terms of controlling, you know, the powerful CEO. And then obviously there has been the rise of putting more stress on looking on the independence to balance the executive and management of these companies. And there again, I mean, I think there's some very significant improvements that you can look at to best practices around the world. I mean, I think this question of overboarding is an issue where people are on 3 or 4 boards. I think 2 should be a maximum. I think there should be probably, you know, an age limit. I mean, this is back to the Supreme Court, you know, where you get rather elderly people that should have probably retired a few years ago. You know, 70 is a bit too close to my age for comfort, but I mean, that's probably a good number. And I think also probably, I know in my home country, where some of these practices are already in place and have been for several years, is, you know, a maximum tenure of 10 years on any board is probably a good limit to you know, because people just seeing these things out. You need fresh blood, you need fresh ideas. I personally, I'm on a slightly tangential theme. I think auditor rotation is also an aspect of governance that probably ought to be certainly considered. I mean, I won't go into some of my thinking too in terms of, you know, breaking the relationship between the auditors and the companies, but you know, I think the direct relationship creates conflicts which repeatedly create problems in terms of, when we have accounting class standards, it's because, the auditing side is seen to be not hard enough in terms of the auditing process compared to the fees that are being generated out of consultancy advice. And that seems to be, however they cut down the consultancy on these guys, it seems to grow back again in a matter of years in terms of the percentage of their businesses. So those are just a few ideas that I would actually throw out in terms of the governance. So as I say, we've come a long way. I think REITs by US standards, corporate standards, in terms of the other areas I look at are kind of probably good, in line, if not a little better. But I still think we've got a lot of headroom in terms of what the scope would be in terms of enacting improvements which would take us to a higher level.
Yep, I appreciate that. And look, importantly too, diversity and inclusion. I think real estate has made headway here, but we have a lot of room to run. We've been championing that among our students, bringing in diverse backgrounds, non-traditional students into the fold. What type of insight would you give our students who want to grow into a kind of a unique role in real estate and kind of bring diverse thought into the sector? What kind of insight would you give them?
Well, I think, obviously the addition of the stress on gender and now more on ethnicity is an important step in the right way. But the bigger goal would be to have people with more diverse backgrounds and thoughts, because, putting people in that went to the same school is that might look a little differently is a step, but it's not necessarily, ultimately getting you to the broader diversity goal that we're aiming at. And I think it's easier to talk about that than actually put it in practice. But certainly, I know the student body at NYU is very diverse and multinational, and obviously I think there's opportunities for those guys to fill into some of these roles that we're talking about.
And I also think that, when interviewing for a role, it's so important to ask the people that you're interviewing their views on this, because while a company may be looking to hire people who look, are diverse and may bring different perspectives to the table, company really has to look really hard at themselves to make sure they're willing to listen.
Yeah.
Right.
Yeah.
Because you can look like, a model UN, and that'd be great, but just make sure, like David mentioned, that not everybody came from the same background, or even those minority voices are actually heard and amplified. So I think that's one thing that a lot of companies need a lot of work.
Yeah, and I think too, again, real estate is a kind of a fairly insular kind of little world. But if you think about, say, retail companies, which have to, they're selling their goods to a very wide demographic. In the United States, every ethnicity and religion, etc., in the world is represented here. I think diversity of the board is seen as really having a huge real business advantages that even the old guy that sits at the top can really understand, right? Within kind of the structure we've got in real estate, which still has many aspects of the old boys club. It's not an awful lot different, quite frankly, from the environment I first came upon 25 years ago when I came to work in this industry in the United States. The incentive isn't quite the same, so maybe they need a little pushing by the regulators to move things along a little bit, in terms of setting standards. And, you look at, I always think of, you think of the Norwegian Parliament, where the mandate is 50% of MPs have to be women, right? Now that's kind of, I'm not sure we want to go, we're ready for that in the United States, but, they're there and they've got it, right? And are they a better country for it? I would argue yes.
Well, one of you said that the idea of having plans, but then also having goals and timelines is important, and that's where what you just said applies.
I often think back to like when I started at M&T as a real estate lender, we always had the checks and the balance, where you do acquisitions, people are the lenders, and you had your credit underwriters. So it's always so important to make sure, kind of any situation that you go into, that the check and the balance are equally heard.
Mm. That's a great point. Like, this has been a really good conversation, a little free flowing, which we're hoping to do on this research day. Hopefully this is just the beginning of many conversations with both of you, but also more joint efforts with Professor Brodsky and the Center for the Sustainable Built Environment. I think the REIT space has done a great job moving ESG forward, but as we all said, it's still early days and there's a long ways to go. So appreciate you serving as a catalyst today.
Thank you.
Very good. Thank you.
Thank you.
Thank you, everybody.